Okay. Good morning, everyone. Thanks for joining our webinar today. This is the Black Diamond team. And today we're going to just do a little bit different than some of our previous webinars. What we're going to do today is spend about 30 minutes of just talking about some deal stories and some ways that we've helped some different clients create some value. And then we'll stop that at 11:30, and then we'll offer 15 minutes of Q&A. We're going to mute you at the beginning of this, and then we'll unmute for the last 15 minutes of questions and answers. Appreciate your time this morning. And of course, this will be recorded and circulated after the fact. So if you have somebody that you think might benefit from something that we say today, feel free to share that with them, and look forward to getting to know those of you that we don't already know. I guess I'll get it kicked off this morning. My name is Christian Baldwin with Black Diamond, joined here with Lane Oth and Robert Edmonds, and then Brian Wagner is also joining us. He's in our Kansas City office this morning. So it's great to be with you, and hope everyone's having a good day so far. One of the things that we come across in our line of work is, buyers and sellers that all have interesting stories and varied backgrounds, and you never know what you might run into when you're doing a merger and acquisition deal. Part of our job when we're representing the sellers is not just to sell their business, that's their primary goal, but really it's to help them transition their business to the right buyer. And that sounds easy to do, right? Find the right buyer, but believe it or not, sometimes that can present some challenges. And so we actually had an interesting deal a while back where a couple of individuals presented themselves like legitimate business owners, and they really wanted to buy a company, and turns out they were convicted felons. And we had to do some extensive background research and then work through that process. And ultimately, what they were trying to do was apply for loans fictitiously and try to buy a number of different companies around the United States. And so we were just lucky enough, if you will, to be one of many that they were trying to use to defraud the government. But the point being is that you get a certain point in the process, and you really have to do your due diligence and understand, okay, what's that going to look like? At what point do you draw the line and say, okay, this is not the right group, right? This is not the right buying group for our client. And we were able to uncover that, do that, and eventually find the right buyer and close that transaction. So it ended up being a good story in the end, but definitely some curveballs that were thrown there at us as we tried to figure out what exactly was going on. So that's one that, trust me, we weren't laughing at the time, but now looking back on it, we kind of get a chuckle out of that. Lane, I know you recently closed a pharmacy down in the Dallas-Fort Worth area. That one also had some great twists and turns, and long-standing family business there. What are some things that maybe you'd like to share with that transaction?
Yeah, that was a recent one we did down in Texas, and one of the great things about it was a great family, great long-standing business, long-term employees, and the new party came in. One thing that we were able to come in and help navigate was the paperwork with pharmacies. Of course, there's DEA, Texas Board of Pharmacy. There's a lot of different agencies, along with a whole list of attorneys we had to work with. And one thing we were, lucky enough to provide value to the family and to both the buyer as well, was really to help manage that, help transfer that. There's a lot of applications and forms and notifications on a DEA side that you have to do that we were able to help with and assist with and help that transaction go through. But when you have these long-standing companies, families, generational employees there who've been there for 10, 20 years, one of the great things that we get to deal with is really when that bit of nervousness comes in. Maybe an employee, it's a big change, it's a big life change for them. Their boss after 20 years is stepping away, retiring, and they have a new boss, and they've known the same way of life for so long. In this case, I got to be a therapist in a sense for one of the employees as on the day before.
Untrained therapist.
Yeah, untrained. I'm not licensed in any way, but got to walk her through, and one of the things we got help with was really just helping her ease her concerns and help with that transition and fluidity to the new buyer. And they're doing great now. So it was a great opportunity for us.
Yeah, usually, there's some nervousness on the employee side, but most of the time, their position is either, status quo, or if not, really enhanced by the new buyers, right? Because a lot of times new buyers have new opportunities and they want to inject some new resources into the business. And so usually, more times than not, I've seen it actually be a better situation for the team there and the business that's staying behind. So yeah, that was a great one. And I know that the family was really pleased to have you help them and see them help pass that torch, for that business that's been around for a long time. Yeah, for sure. Robert, tell us a little bit about a situation where I know we had a deal and it was we were trying to help this company buy another company, and they had tried unsuccessfully in the past before they brought us on. What were some of the things that you found really added value to help get that deal done?
Yeah, so we had a company that had tried to negotiate the purchase of another company, and over a period of months, and so there was several things that seemed to be getting in the way of that being done. So they engaged us. We were able to go over to that office and sit down with the owners. And I'll tie this back to, it's a very emotional thing in a lot of cases when the negotiations are being done. Anything from personality to just conflicts with just the way things are said or misinterpretation, and the list goes on. And I think that in that particular deal, things were just getting twisted around, and they were just stalled out. They couldn't get anywhere. And I think there were a lot of emotions involved in it. So when we sat down, basically with the owner and their spouse, which was part owner as well, we were able to really just cut through all of the confusion and the emotional part of it and just get to what is it that you really want to accomplish. And then, of course, we could go back to the buyer and say, here's what we want to try to do. And we got that piece out of the way and got the emotion out of the deal and really just got down to what everybody was trying to accomplish and what they were wanting out of the deal and what they were trying to get personally and for the legacy of their business. And really kind of rack all that up into a common sense approach and find out what were the imperatives and what were the things that could be possibly compromised on and really move forward with the deal pretty quickly, actually. So yeah, it worked out well.
Yeah, that was a good one. To your point, one time we had a deal where two business owners, they were partners. One was older than the other, and he wanted to sell to the younger guy, and the younger guy wanted to buy the rest of the equity from the older gentleman. And they worked together great every day. I mean, great business partners, no animosity whatsoever. They could not get the deal done. And I found myself at the kitchen table in one of their homes talking to both of them, just the three of us. And I mean, just very emotional because the guy that was the older one, he really didn't want to let go. He didn't really want to retire, but he knew he needed to. And I mean, lots of tears and, and everything. And to come right down to it, the reason why he didn't want to was because every Friday he would take a couple $100s out of the register and go gamble. And he didn't know where he was going to get his play money. And his business partner knew it wasn't, he was trying to keep it from him. It was his wife he didn't want to know. And so he said, where am I going to get my blackjack money? And once we got that out on the table, we could solve for it. And they're both extremely happy at this point. But I'll never forget that because it was an emotional trying to figure out what was really holding him back, $100 a week to play blackjack was what it was. Brian, let's go to you now and turn it over to you in our Kansas City location. Tell us about a time where we're going down the closing. We think we have the right buyer, and oops, at the last minute, something happens and we get thrown a curveball. I know we had a recent one where this came into play. What are some of the things that you were able to do to not only salvage that deal, but in the end, really replace them with what turned out to be a better buyer in the end?
Yeah, it's never over till it's over. I mean, we had a group that provided consulting services and also had a software solution that they used to support their consulting business. And we had found a strategic buyer at a good price, a good structure, one that was going to have them participate in a meaningful way, kind of going forward in the transition of the deal. And we got to the due diligence period. We were trading the definitive documentation back and forth, so we were pretty far along, and the buyer started to kind of back away a little bit and ended up lowering the value that they were going to be willing to pay for the deal. And again, we'd spent a lot of time on this and ended up deciding that value that they had proposed at the end was unacceptable. And so we stayed firm, and the buyer ended up walking away. So we had to kind of scramble to find a replacement. And what we ended up doing was going back to everybody that had sort of shown interest in the past, just because, again, you spend a lot of time on these things. It can be frustrating when they fall apart, but we were able to go back to an interested buyer that we had talked to previously before going down the path with this other group, and they ended up getting back in the mix. We had an easy bulleted list of terms and conditions for the deal that we were willing to accept. And we were able to get them through a due diligence period, sort of a shortened due diligence period, because we had everything ready. We knew where the questions were going to be answered, we knew the questions that were going to be asked. So we were able to take them through that process in a more efficient manner, and ended up closing the transaction with this new group. And it ended up being a better deal, I think, overall, just from a fit perspective. Like I said, the owners of the business were going to transition in some capacity. The business was very reliant on the owners, so they wanted to ensure that transition was handled smoothly. And I think it was a better fit, and they ultimately got a better financial deal out of the equation. So that it's never fun, again, when you spend a lot of time, you go through the due diligence period, you get close on a purchase and sale agreement, and a buyer backs out. But I think there are a couple lessons that I sort of took away from that. One is, like I said at the beginning, it's not done until it's done, and there's still a lot of things, a lot of hurdles that you need to jump through or jump over to get a transaction closed. And you gotta know your worth at the end of the day, and not get sort of sucked into the trap of deal fatigue and just doing a deal because you spent a lot of time on it. You still have a value that you have in your mind, and in this case we stuck to it and ended up working out for us. These transactions take a lot of time, but you want to make sure that you find the right fit, the right buyer, and we were able to do that, even though sort of our original buyer kind of backed out on us at the last minute. So that was a fun one for sure.
A couple things I remember about that were important that came into play there. The business actually was doing better than we projected originally, and yet the buyer's own pro forma, they had put so many more expenses on a go-forward basis that was the justification of the change near the end, which made no sense to us whatsoever. I mean, it wasn't the seller's prerogative that they wanted to hire more labor, which seemed unnecessary, or fat salaries and things like that. So there was some negotiation there that ultimately led our clients to feel like, maybe this isn't really the right group to take our company over in the long run. Our role is really to quarterback the transaction and try to present the facts as they are, and to work a deal to completion to the satisfaction of all parties. And so we're not the law expert or the accountant expert per se, but having those voices and minds at the table with a big picture overview to make sure everyone's on track as we go down the different steps of the deal process. Let me ask a new question. One of the things that we get hit with all the time is from business owners, should I grow this business? Should I keep on doing what I'm doing and continue to grow it, or should I sell? I know we've all had conversations like that with various business owners. What are some of the things that you guys are hearing in the market today? And, how would you address that with a business owner that might put that on the table?
I'll say one just recently we had, that was a prospective client. Their concern was they had felt like they had reached their runway, that they had taken the business as far as they could take it. And they were really contemplating on, what do I do next? Because I don't know that I can take this any further. My skill sets don't necessarily, so they were, catered to taking it to the next level. So a lot of intense thought around that, and not sure where they landed at this point, but they were really trying to figure out what to do to go to the next level. And of course, we proposed you could possibly bring in a partner that has those skill sets. You could obviously sell currently where you are and cash out now, or take some portion and cash out with a partner. And so there are real issues out there, and people struggle with them for sure.
Yeah. One of the things is that, no one likes to hear this answer, but really the answer is it depends. It really depends on the objectives and where they are in their business. Most of the time, that conversation that I have always ends up being remain as flexible as you can. You don't have to sell all of your business in one day, right? There are so many different things you can do. We can bring investors to the table that are debt lenders. We can bring investors that are equity investors that are just, depending on what everybody's objectives are. We've got a meeting set up where the first thing we're going to do is just whiteboard everyone's goals and objectives, right? To try to see, okay, what's going to make everyone happy, right? If your business has gotten to a certain point and you want to grow it to get to the next level, can you do that on your own? Right? And is there real estate involved? If there is, then you might have a few more options, because you could do some things with growing physical locations that are easier to do through lease structure and things like that. So those are some good points, but remaining flexible, I think, is one of the key takeaways there.
Yeah, one of the key things to also I think about it is beyond work, your personal life. There's age, health, family, moving. There's all these different factors that come into play that you want to use as your evaluation on what you want to do. Your business, you can be at a state of flat line, and you might be at a point where you want to move or go back to family, and it could be a time to sell. Or you could say, it's time to bring on an investor and maybe add another location in this place where I want to go. So there's a lot of different options, but it's good to factor in the life outside of work as well into that decision.
Yeah, that's a good point. Ron, what do you think?
Yeah, no, there's all great points, and I think your expectations have to fall into line for this decision too. I mean, we deal with some clients that see massive growth potential in their businesses, and the decision, do I sell now, or do I kind of take the ride and ride this out? And going back to Christian's point, I think that there are just so many options for that. If you make the decision that, look, I want to step away from this, but I don't want to lose, the opportunity to sort of participate in the upside of my business. There are structures that you can look at that compensate you for hitting growth objectives. You can take a step back and work as a consultant, as an advisor, taking an equity role in the business going forward, rather than, sort of your day-to-day operation, or, your day-to-day responsibilities. So, I just echo what Christian said, because I think that's really important. Is, there are options, and it gets back to, what are your goals? What are your objectives? Do you want to leave now and just retire, spend time with the family, or do you have a little bit more runway in you to kind of see some of the growth initiatives through? We deal with those conversations all the time.
One tool that's pretty neat, I think, in our world is the mezz loan, right? We've seen a handful of transactions where the current owners, they don't really want to give up any equity, but they know they need capital to grow. So, on the sidelines sit these mezzanine lenders that are really, maybe high net worth individuals, and they'll say, look, I'm happy to loan $1 million as sub debt to a primary lender at a rate of, anywhere from 10 to 15% interest only, though. So it's palatable for the business in terms of cash flow and overall debt service coverage. And they're going to use that for, let's say, 2 or 3 years. And then they're going to refinance down the line with a bigger cash flow at that point. We've seen that work a number of times, where the current business owners don't have to sell membership units or stock or whatnot to get an equity partner, yet they have a partner in a lender that's different from a bank. And so those can really help get deals done, also for growth in particular. One of the great things that's been happening, in our industry lately is, well, it's not necessarily a great thing, but it's been termed the Great Resignation, which was a byproduct of the pandemic. We're starting to have some conversations with business owners that are scratching their heads and they're thinking, you know what, maybe it's time to not go through that again and to look to exit my business, or at least pass the responsibility on to someone else. Or maybe they've had a key member of management that has resigned, or is no longer a part of their team for whatever reason. Going back to what you said, Lane, on the personal side, I think going through a worldwide pandemic has caused a lot of people to really sit down and think about what's important to them and how that's going to change what they do for a living, right? And we've seen this at all levels. I mean, it's in the construction trade, it's in the hospitality industry, and I don't think it's really settled out just yet. But how do you guys advise clients or potential clients on how to think through those scenarios?
Yeah, we talked to one this morning. I mean, staffing is an issue across the board. No matter how big or small your business is, trying to I think it comes down to retention and what it is that makes someone want to stay where they are, and versus giving them a reason to leave, and sometimes it just depends on the drive and the motivation of the employee itself. If they're just totally in it for the money and it's not about the culture, then they may just leave for the higher dollar. But in most cases, I think they've got reasons for going somewhere else. And so I think employers have got to tighten up their, what it is that really from a cultural standpoint, from a benefit standpoint, and communicating that, because a lot of times employees don't even know what they've got. And that's an issue. It's like, make sure that they understand the total value of what they've got in the place of employment where they are currently. And that comes down to just education and training and just making sure that they know what their total benefit package is.
Right.
Yeah, I might touch on this from that's a great point, Robert. And I might touch on this from how buyers are looking at things too. When a buyer looks at your business, they don't want to come in there and then immediately day one all your employees leave. Getting back to the point about I think that Lane made about the having the same boss. Well, what's my role going to look like when this new owner takes over? And so I think buyers are starting to take a more creative approach to employee compensation, specifically key employee compensation, and giving ownership in the business, providing equity incentives, better bonus structures. I think all of that is designed to create, as Robert touched on, create that that feeling of ownership with the employees, to where they feel like they are driving success of the business and receiving some of the benefit of that success. And I think that's a really important component for buyers right now is how can we keep key employees around, keep them happy, keep them motivated, and keep them well compensated, so that everybody's sort of steering the ship in the same direction. So that's been a big topic for a lot of buyers is that key employee retention. And I think you're starting to see a lot more creative structures and solutions that have come out of that.
Culture's it's a hard thing to establish sometimes, and then it can be even harder through a transition. I know you've seen lots of examples of that, right? Where you have big companies swallowing up smaller companies, and the culture can be it can really be detrimental if there's not a good match for that, or if the buyers misinterpret an existing culture, and then you have a big mass exodus down the road, which is something that is not really good for the employee or the employer for that matter. What are some things on the culture side that a buyer should really spend time in due diligence? Because I'll be honest, I mean, most of our due diligence lists don't have any culture items on it, right? I don't know that I've ever seen one from a lawyer that has anything to do with culture on it at all, in fact. So why is that, and what are some things maybe they should look for?
I think in general, when a company acquires another company, it's really that first day, what's the priority and the verbal and nonverbal message that the buyer is sending out to the employee base. So when a buyer comes in, I mean, I think the first thing, if your employees are the most valuable asset, it's not to go into your office and have meetings with a select few. It's talk to every single employee, or have employee meetings with, if you have more than you can get to because of the size of the company, then have an all hands meeting. Make them feel like, because it's an unknown for them from the employee standpoint, they don't have an idea what's going to happen. They just have conjured up things they're thinking about and anxiety of what could happen.
The fear of the unknown, really.
The fear of the unknown.
Right.
So the way to initially to mitigate that is get in front of them and get in front of as many of them one-on-one and give them reassurance, give them kind of what the thought is going forward, and create a message that permeates the entire organization to calm everybody down day one. And that solves a lot of issues. And then, of course, you can't just go silent for 6 months at a time. You need to follow up with that.
That's a lot of great points, and just one specific example I can give to that, because we don't see it often. It's usually one of the first questions: will the employees stay? Do they want to stay? But I once in a transaction recently had a potential buyer that came into play that solely wanted to buy the company for its employees to help his company. He wanted them to kind of merge together, but he was at high capacity himself and couldn't keep up with his growth. So he had built out a whole model for the employees to have a role between both companies, and they would be more fluid in both and have a lot of growth opportunity in their career. He saw it as a big career development. So seeing something like that, helping, if you're strategic and a buyer trying to grow your business through acquisition, it'd be great to help build a model, a plan to give to the owner you're trying to buy from, to help alleviate those concerns on his or her side, or for the employee as well.
Yeah. I think the best example I can think of where I've seen it work really well is when a buyer listens first, even if they know what they want to implement down the road. The ones that seem to go very, very well are the ones where the new buyer introduces himself or herself, and the very first thing they say is, hey, the reason why I'm investing in this company is because of you, right? The people. And then they just listen to the team, listen to what it is that they like, what they don't like about their current situation, and then they get their feedback on how they can help grow it. So you have an immediate buy-in. And those I really like to sit in and take notes on, because you always learn a leadership lesson just listening to those leaders, deliver that message to the team. And that's how they bring them on board. Okay. Anything else